Hello guys, welcome to Trading X-Ray. Today we will learn about the candlestick history. This pattern is developed in the Japan and it is developed around the 18th century. So you can imagine how old it is. The main purpose of the candlestick at that time was to find the pattern between the buyers and sellers in the rice market, not the stock market. There was a rice trader whose name was Onihisa Homa who developed the candlestick pattern, and he tried to analyze all the psychology of buyers and sellers. According to it, he is able to find some patterns from which he can able to predict the next day trading of a rice, and he is able to get a lot of profit in them. Now we will learn about the candlestick, how it is shown and how we have to interpret. As you can see on the screen, there is a two candle, one is green and one is red. The green means it is a bullish candle and red means it is a bearish candle. Bullish means price is going up, bearish means price is going down. And there is four parts in the candle. One is open, low, close, high. The same thing in bullish and bearish candle, but in bearish the open is above the close, and in bullish the open is below the close. Now you can see there is a gap between open and low and the gap between high and close. This signifies that the price, whenever the price moves, it also creates some buffer before giving the close. So when it makes low, then there is a small wicks. In green candle, it means whenever the price is open, the buyers is trying to push the price to the close price, but before going to the close price, the price drops and makes a new low, and then again buyers get aggressive and push the price to the close price, but before closing it also reaches the high, which is actually greater than the close, and then the price starts falling from high to close. There are mainly three components of the structure in the candlestick. One is body, which is actually the difference between open and close. Second is head, which is the difference between high and close, and high and open, and the tail, the difference between open and low. This part is also known as wicks, head and tail, and according to price action we can find an interesting pattern according to the ratio and size of head, body and tail. The head means price is trying to make a new high, going to move up, but sellers became active and pushed the price below. And in the tail, it means the price is falling in starting, but the buyers dominate and move the price up. So we have to consider the main body as difference between open and close. See in the chart, this is a trading view terminal. Now we will see how to apply the candlestick chart. Currently this is a line chart which contains only closing price of the particular time frame. Now we will choose candle. Now this is a candlestick chart. It has open, close, high and low of the particular time frame. Now find the head and tail and the body in these candles. As you can see, there are lots of wicks. Some candles have a greater tail as compared to heads, and some candles have greater head as compared to tail. Whenever the tail is greater than head, there is a chance of moving up. There is a buyers active and they can move the price upside. As you can see, it is a live market and the price moves up. That's how you have to learn.